Good morning. Today's Monday, November 6th. Hope everyone had a nice weekend. My wife and I got to go to, apparently baby moons are a thing now, like honeymoons. So for our slash her, mostly her, baby moon, we went to the Biltmore in Asheville for the weekend. Um, so that was fun. They have their Christmas decorations up this time of year. It was beautiful, and we walked into. I didn't know what to expect other than a massive building that was at some point someone's home. But when you walk into like the main entrance, there's literally like a choir of people singing Christmas songs. It was bananas. But we had a good time. Hope everyone had a nice weekend. I know the weather's finally cooling off here in Charleston. I think this week is supposed to heat up a bit, but um, getting to the point where I can wear a sweater, which is nice. Uh, I get to do the fun video this week. Last week, Johan was talking about, and ironically, he was talking about how frequently the market corrects 10% um, over a given period of time. And just a week later, I get to talk about why the market had its best week of the year in 2023. Exactly why we don't want to be reactionary to headlines. Um, when Johan puts out a video on how frequently do these 10% corrections actually happen, it's kind of a trigger in our office of like we may be getting some calls here soon, so let's try and get some positive information out um, about what the market's doing and why this is happening and how common this kind of thing actually is. But it's funny that a week later, so last week the market was up. S&P up 5.29%, Russell 1000 5.6%, Russell 3000 5.67%. Depending on what index you're looking at, small cap value last week was up somewhere between 7 and 8.5%. So this is just a week after we're talking about 10% corrections. So what happened? What happened in the news to cause this, or what was the trigger for this? So there was a jobs report last week. U.S. payroll increased 150,000, which was short of the 170,000 forecast. Unemployment rose to 3.9%, which is the highest it's been since January of 2022. And at kind of the surface level, all of that sounds like not good news. But what's taken away from that is that the Fed kept rates unchanged, and the probability that we've seen the end of rate hikes has increased. By no means am I saying it's gone away entirely, but when you're looking at markets and how markets are moving, a lot of it's almost entirely people forecasting out 6-12 months in advance the probability of rate hikes, the probability of the Fed pausing rates, interest rates dropping. So it's kind of funny to see a week after Johan's video that I get to do a fun video. A lot of additional goodies for you guys today. So I-bond rates for November came out, and they're a little misleading. We've had a couple clients reach out with questions about, hey, why are you telling me to redeem these? They say the rate is 5.27%. So that 5.27% is a little misleading. So there's a fixed component and an inflationary component to those I-bonds. The fixed component is only applied for newly purchased I-bonds. So in that 5.2% composite rate that you're seeing, or that you may be seeing, 1.3% of that is the fixed rate, and the inflationary rate is 3.94%, which is still a pretty reasonable rate. The issue is if you already own I-bonds, put another way, unless you buy them beginning in November or buy new I-bonds in November, you're not going to get that 1.3% rate with your I-bond. So it's just going to be that 3.94%, which is an annualized figure. So the inflationary rates previously were 3.94%, or was this one. 3.38 was released in May of this past year, or of this current year. 6.48% was last November, and then that 9.62% was that previous May. So a little bit deceptive. Still makes sense to redeem those. I know with those of you that we were able to meet with in the fall, we sent you home with a chart as to when to redeem those. So that chart still holds true. Just find on the left-hand side the month and year you purchase them, and then work your way all over to the right in the month that makes sense to redeem them. Moving on, told you I had a lot of fun things for you today. 401k and IRA contribution limits for 2024 were announced. So 401k limits are going up another $500. So from 22,500 to 23,000. The catch-up contribution unchanged. So for those of you that are over 50, that is still at $7,500. IRA slash Roth IRA contributions got bumped up another $500, which is nice. So those moved to $7,000 a year, with the catch-up contribution being an additional $1,000. So $8,000 if you're over age 50. So nice that, as you know, it's kind of, between if you're over age 50, between your 401k, your catch-up contribution, and your IRA contribution, you can put in, 38,500. That's pretty good chunk that you can toss into retirement accounts later in the game here if you're playing catch-up, which is awesome. Last thing for you, client appreciation. We've already had a lot of people RSVP to this, so thank you for that. I'll be following up with some emails just to make sure we have all the info we need. But we sent those invitations out to the Stingrays games that we do every December. So looking forward to that. Questions, comments, concerns, do not hesitate to reach out. Have a great week.